Friday, April the 11th, 2025.
Don't.
And welcome everyone to the FinWell Daily Brief.
Good to be here.
This is our 18th briefing, and the markets certainly kept us on our toes today. Lots to unpack.
Definitely quite a session.
But hey, before we dive into all the market action, let's start with our financial fact of the day.
Yeah.
And this one, well, it's pretty staggering.
Let's hear it.
Get this. In 2024, India's UPI, the Unified Payments Interface, was processing over 12 billion transactions every single month.
12 billion. Wow.
12 billion. I mean, just try to wrap your head around that scale. It's huge. Really shows how central digital payments have become, doesn't it?
It absolutely does. You know, that number, 12 billion a month, it's more than just a statistic. It really paints a picture of India's digital transformation. Think about the reach, the convenience. It's phenomenal. And it makes you wonder, what's next? What kind of innovation builds on top of that?
Exactly. The potential seems enormous.
Yeah.
Okay, so with that mind-boggling fact as our backdrop, let's get into today's market movements. Because after a bit of a lull yesterday, things really took off.
They certainly did. A sharp rebound.
Right. Indian equity saw a really strong comeback. The Nifty 50, it closed at 22,828.55. That's up 429 points, give or take. A jump of 1.92%.
Yeah, a very healthy gain. Feels like sentiment really shifted today.
It does. So was there a particular trigger? You know, something specific from global markets, maybe?
Well, the reports point towards improved global cues feeding into that optimism. We can dig into that a bit more. But yeah, a definite risk-on feel today.
Okay. And it wasn't just the large caps, was it? The mid and small caps had a great day, too.
Oh, absolutely. They performed very strongly.
The Nifty Mid-Cap 150 finished at 18,626.85. That's up 354 points, or 1.94%. Solid.
Very solid indeed, keeping pace with the main index.
But the real fireworks, you could say, were in the small caps. The Nifty Small Cap 250 closed at 14,786.30.
Yeah.
It rocketed up 440 points. That's a whopping 3.07% gain.
Now that is interesting. Often, you know, when small caps lead the charge like this, it signals a real increase in investor risk appetite.
Right, like they're looking beyond the usual suspects for growth.
Precisely. Betting on potential, perhaps willing to take on a bit more risk for potentially higher returns. It suggests a broader confidence, maybe?
Makes sense. And just to round it out, the Nifty Total Market Index, covering everything, closed at 11,662.20. That's up 228 points, a solid 2.00% overall.
So yeah, a very broad-based recovery across the board. That linkage to global cues seems key here.
Explain that a bit more. What exactly are these global cues doing for us?
Well, think of it as the mood music from major international markets. What happens in the US, Europe, Asia, it sends ripples.
Okay.
If things look positive overseas, maybe words ease about, say, inflation or interest rates there, that tends to make investors feel more confident about putting money into markets like India. It improves the overall outlook.
Got it. Okay, let's switch tracks along to bonds and currency. Now, the report mentions data for the 10-year Indian government bond yield wasn't available at the time of closing.
Right. Sometimes there are lags in that data feed.
But the currency market definitely had some news. The Indian rupee, it strengthened quite a bit against the U.S. dollar.
What's that?
The NRI USD rate is at 86 now. That's an appreciation of 0.8% for the rupee. Pretty significant for one day.
It is quite significant, yes. And the reason seems fairly clear. It moved up along with other Asian currencies. And that was mainly because the U.S. dollar itself weakened quite noticeably on the global stage, reaching reportedly a near two-year low.
I see. So it wasn't just India-specific strength. It was more about the dollar weakening against a basket of currencies.
Exactly. It's always relative, isn't it? A weaker dollar makes others, including the rupee, look stronger by comparison. Could be driven by U.S. economic data, Fed expectations, that sort of thing.
Right. Okay, let's dive into some of the other big news items floating around. We mentioned the rupee strength, that 0.8% gain to 86 against the dollar, linked to the weak dollar.
Yes, that's a key factor today.
But then there's the ever-present issue of U.S.-China trade tensions. They seem to be escalating again, causing more volatility.
Yeah, that narrative seems to be bubbling up again, and whenever that happens, it tends to make markets quite jittery.
How so?
Well, friction between the world's two biggest economies creates uncertainty, disrupts supply chains, hits business confidence. Investors get nervous, they might pull back from riskier assets, look for safe havens. It impacts global equities, and we feel that here too.
Okay. And that uncertainty seems to be hitting oil prices too. Brent crude futures dipped 0.6%, down to $63 a barrel.
That fits the pattern. If there are worries that trade disputes will slow down global economic growth,
then the expectation is less demand for oil.
exactly. Lower expected demand tends to put downward pressure on prices. It's all interconnected. Trade worries, growth concerns, oil prices.
Now, here's something interesting. Despite the strong rally today, the report notes that foreign investors were actually net sellers of Indian shares just a few days ago, on April 8th, sold about $544 million worth.
Ah, that's a very important point, yes.
So what does that tell us? Is there still some underlying caution despite today's jump?
It certainly suggests that, doesn't it? It could be profit-taking after previous gains, or maybe some large funds adjusting positions due to those broader global concerns we just talked about. It reminds us that one day's rally doesn't mean all worries have vanished. Sentiment can be complex.
Right. Not always a straight line. And another piece of the global puzzle, the yield on the 10-year U.S. Treasury note. Apparently, it's heading for its biggest weekly gain since way back in 2001.
Wow, since 2001, that is a significant move.
What's driving that, and what are the implications?
Typically, a sharp rise in Treasury yields like that reflects worries about inflation picking up in the U.S. And that, in turn, fuels expectations that the Federal Reserve might need to keep interest rates higher or raise them further. It signals nervousness about economic stability, and higher U.S. yields can draw capital away from other markets, potentially impacting borrowing costs globally.
So lots of moving parts globally. Okay, let's try and bring this together then. Looking at the market outlook, today's big rally in India definitely suggests a positive turn in sentiment. And that weaker dollar is clearly helping.
Absolutely. The weaker dollar is a key piece.
How exactly does the stronger rupee make our assets more attractive to foreigners?
Well, it's twofold, really. First, if you're a foreign investor holding dollars, a stronger rupee means Indian stocks or bonds are effectively cheaper for you to buy.
Right, you get more rupees for your dollar.
Exactly. And second, if you earn returns in rupees, when you convert that back to dollars, a stronger rupee means those returns are worth more in dollar terms. So it boosts the potential payoff, making India more appealing for capital inflows. That's key for listeners tracking foreign investment.
Okay, got it. But those U.S.-China trade issues, sounds like we need to keep a really close eye on them, especially for our export sectors.
Definitely. It's a major watch point. While some argue India could benefit from supply chains shifting away from China.
The China plus one idea.
Right, but prolonged serious trade friction hurts global trade overall, and that inevitably impacts demand for exports from everywhere, including India, so it's crucial to monitor those developments.
And looking at specific sectors here at home, the report suggests IT and pharma might actually do okay, maybe even benefit from some of this global uncertainty.
That's plausible. These sectors earn a lot in foreign currency, especially dollars. So a weaker dollar can actually help their earnings when translated back into rupees.
Ah, the currency effect again.
Yes. Plus, demand for IT services and healthcare tends to be relatively stable even when the global economy gets bumpy. So investors might see them as safer bets in uncertain times.
Makes sense. And then domestically, the report flags infrastructure and consumer goods as potential bright spots, thanks to our own economy's resilience.
That's the domestic growth story. If government spending on infra continues and consumer demand holds up here in India,
those sectors could perform well regardless of global wobbles.
That's the idea. They're less directly exposed to some of those international trade winds and more tied to what's happening right here at home.
So given all this, the global factors, the domestic picture, the sector variations, the advice seems clear. Diversification is key.
Couldn't agree more. Spreading your investments across different sectors, maybe even different asset classes, is just prudent risk management, especially when the outlook has so many moving parts. It helps smooth out the ride.
Right. Okay, so let's summarize. Today's strong market rally, a welcome sight, seems driven by that helpful combination of favorable global cues, like the weaker dollar, and confidence in India's own economic strength.
Yes, a positive day reflecting both external help and internal resilience. A good combination to see.
But, and it's an important but, we absolutely need to stay watchful. Keep monitoring those international developments, trade talks, inflation signals, central bank moves, because they can shift the mood pretty quickly.
Absolutely. Vigilance is key. Things like the U.S.-China situation or shifts in U.S. interest rate expectations can definitely impact flows and sentiment here. Stay informed.
Definitely. Now, if you found this briefing useful and want to keep getting these daily updates on market action and financial news, please do make sure you subscribe.
It helps you stay ahead.
And for more detailed insights, or if you just want to discuss things further, please feel free to contact SOS FinWell over on LinkedIn. We'd love to connect.
Yes, engagement is always welcome.
In fact, you can reach out directly to SOS FinWell on LinkedIn with any thoughts or questions you might have after listening. Don't hesitate to connect.
We're there.
All right. And finally, to leave you with something to ponder, our quotation of the day is from Robert Arnott. He said, "In investing, what is comfortable is rarely profitable."
Food for thought.
Indeed. A reminder that sometimes the best opportunities require stepping a little outside that comfort zone. Thanks for tuning into the FinWell Daily Brief.